This is Securities Lending Fundamentals. And today we're going to be talking about trading workflows. We'll be working through how you go from locating stock to doing that trade execution. So if securities lending is something you're interested in, then this is the place. So let's get to it. Hello, everyone. As I said, Roy Zimmerhansl here. Let me just get my slides up with my handy dandy slide pack, which I always have ready. If you are interested in downloading the slides for this session or any of the previous ones, just go to the link that I'm actually showing on the screen right now, register, and in the next couple of days, we'll send them all through to you, the ones that we've done so far, plus weekly updates. So I hope you enjoy that. So what we're going to be talking about today, as I said, are the trading process workflows. Let me just go on to the next slide. Okay. So these are the previous weeks, the sessions that we've done, from everything why does securities lending exist to last week when we talked about the impact of Lehman Brothers on securities lending. Today, as I said, is trading process flows. So logically, you would expect next week to be on post-trade flows, and that's what we'll be looking at. And let's get to it. So what are we going to be talking about today in this week, which is part 15? We're going to be looking at the pre-trade flow, the locate process, executing trades, and the actual borrow at the end of it. So those are the methodologies. Right. This is, as I said, week 15. We've done 15 of them, and we get a lot of positive feedback. The subscribers have been going. The interaction has been picking up, and I've had some great suggestions, like today's session, on episodes that you want to see. That's what we're here for, is to give you information you want to learn about securities lending. That's what it's about today. So if the videos are helpful, this one or any of them, please give us a thumbs up. That'll help it get out to more people and help us educate the world on securities lending. It's a global business. So if you touch it in any way, it's better to have more people involved than fewer. Okay. If you also think that it adds value, please subscribe and ring the bell so you can find out every time we put up a video. Now, I am going to say hello first to always one of our first viewers, Jean-Pierre. Great to see you again. Thanks very much for tuning in this week and every week. And the man from down under, David, really appreciate you being here. Again, it's always an honor to have viewers here. And LinkedIn is letting me down. LinkedIn hardly ever lets me see who it is. I don't understand how it works, because I can see David having said hello, and I've seen a great thumbs up from someone. Unfortunately, I can't see who you are. So thank you in any case. Right. Let me get to it. So the pre-trade process really starts with someone wanting to put a short sale on. They have an idea, they have a strategy, and the regulations in almost every country require you to make sure you can borrow securities before you put on a short sale. And so I've given some examples there, and these extract slides came from an earlier session, I think on June 5th. I'll put a link. Now, how does that go? Either here or here. I'll put a little link into it after I do the editing. It'll be in one of those places. It'll be news to both of us when you see this. But both of those slides are taken from that session. One of them talks about Reg Show, which is a U.S. regulation which mandates that locates done before a short sale is put on, and an equivalent, similar, but there are slight nuances to the European regulation, but also Hong Kong and other markets have similar rules. So why is that? First of all, when you're short selling, you are selling something that you don't, and whoever buys it from you needs to be confident that you'll be able to deliver it to them. And if you don't have it, and it turns out you can't borrow it, well, they'll never get their securities. And that's a problem for the market. So part of it is to make certain that there's a good likelihood that you'll be able to borrow those securities before putting on that short sale. So that's one objective. The other objective is that it's an indirect soft limit on how big a short sale you can put on in the market. So what do I mean by that? Imagine a stock trades a million shares a day, and stock market prices, and in fact, every market prices is really driven by supply and demand. And so if it normally trades about a million shares a day, that means there's a million buyers, a million sellers, or a million shares worth of buyers and sellers. And if that's disrupted, if there are more sellers than buyers, the price is likely to go down. Just in the same way that if there's more buyers than sellers, the price is likely to rise. So if you had a short seller wanting to put in a short sale, so increasing the supply of sellers, and it was distorted, it was 10 million shares versus a normal 1 million trading market, of course, that would have a negative impact on the market. And the thing is, they probably can't ever deliver that. So it's a phantom trade, and it could be argued that's market abuse. So by requiring a short seller, or a would-be short seller at this stage, to locate shares, they need to find someone or multiple people that will sell them enough shares or lend them enough shares so that they can execute the short sale in the market. And what that means is, practically speaking, if you look at the total float available from a company, the total shares in issuance, and then you whittle that down to the number of investors that make their shares available for loan, that's a much smaller figure. That's often in the neighborhood of 20%. So if you start with 100 shares in float, maybe only 20 of them are actually available for loan. And then if you look at the number of shares that are on loan, let's say 5 of them are on loan, so 25% of the supply, and that's a little bit high. That's higher than average, but it's not a crazy figure. So now you're down to 15 shares out of that original free float of 100. And then there are limits. So some investors have limits, regulatory wise or self imposed, as to how much they can lend out. And sometimes they also have limits on how much any one individual borrower can borrow. And they exclude some borrowers. So let's say that 15 shares actually gets down to 10. Now all of a sudden you can only borrow 10, but it looks like at the beginning there's 100 shares that in theory can be borrowed. Actually, no, there's only 20. In fact, no, there's only 10 available. So you can see that just almost by natural selection, there's a limitation that makes it much more of a tradable and deliverable market size. So those are the kind of two reasons why regulators put in these pre-trade requirements to locate shares before you put on the short sale. As always, I hope this stuff makes sense. If it doesn't, feel free to put a question into the slides. So here I'm going to talk about the locate process, and that I'll explain that funnel in a minute because that's a practical illustration of what this process is. So imagine all of the lenders and the lender intermediaries, like the agent lenders, they send all of their available stock to the borrowers every day. This is how much we have available, and these are the number of shares that we have available in the market. So now the prime broker, which is usually the borrower, they now have these files that say, look, all of this supply is there. What they do is they aggregate all of that up. Many of them put filters on it based on their experience with the lenders, based on their size of their client base, based on the availability of the positions. There's lots of different reasons why they might filter that information. Then what they do is they have this file at the end. They go, we're pretty confident that this number of shares is really available to trade, and we don't really have to worry about it because those are liquid stock. There's lots of supply there, and they are good to actually trade. And what they do is they give that file to their clients so that their clients can have a starting position themselves that say, look, all of these shares are available to borrow, and I don't need to ask. That's what good to trade means. These are good for hedge funds and other traders that might be short sellers to execute short sales without having to contact their prime brokers. Now, the final point there says, as the hedge funds or whoever the end short seller is, as they execute positions, they decrease the amount available. So let me give you in that diagram here a practical example of what that means. So at the top, we have the lenders, all the different files coming into the prime broker, showing there's a million shares of a given stock. And of course, these files typically have hundreds or thousands of different securities listed in them. So the prime broker receives all of these files, shows 1 million shares of ABC stock are available. They decide, well, of that, we're pretty confident that 500,000 of it is very stable. They have 10 clients and they send out in their file 50,000 shares to each of the clients. And they say, you can trade up to 50,000 shares of stock ABC without having to get in contact with me. Now, the record keeping obligation is for the short seller. So the hedge fund, for instance, here has to keep a record. And they say, look, we got a file from our prime broker. It showed 50,000 shares. I've done a short sale of 25,000 shares, and it has a reference number 12345. And they have to keep that record often for as long as 7 years in case regulators come in and say, show me evidence that you were able to do one of these locates. So they have that. Of course, that means that they take that 50,000 share position down to 25,000 shares, and they can trade up to 25,000 shares with a residual amount, but they can't trade 25,001 because there's insufficient there. Okay. Now, realistically, I've shown it as the prime broker showing 10 clients, all with 50,000 shares. It's likely that in many cases that gets skewed relative to the size or importance of those hedge fund clients. So they aren't necessarily going to show exactly the same file to everyone, but in any case, it has to all add up correctly so that they don't overcommit what is available. Okay. So hopefully that makes sense. So you now have a number of short sales that have been done, and you have some would-be trades. So for example, this green box, green words here, that actually shows those short sales that were executed in the market. So the prime broker is going to have to go borrow that. So it's gone from theoretical to a real short sale, and the prime broker needs to borrow. But in my example where there's 25,000 shares left and the short seller wants to short 25,001 shares or 26 or 30 or whatever it is if it's more than the amount in the good to trade file, so it exceeds the good to trade file, or if there's stocks that are not on that good to trade file. So these are I would call these harder to borrow, but not necessarily hard to borrow. They just aren't on the freely executable good to trade position. So for all of those different types of transactions, the hedge fund contacts their prime broker. Here's some that are traded. You need to borrow those. Here's some where I need feedback from you, some of which are stocks that are on the good to trade file. Those will probably get covered pretty easily. And then there's the other stocks, and that's really what the prime brokers are trying to then go out and find. So those are the three types of trades. Now, when the prime broker is trying to determine where to go for those securities, I've done a little bit of green, amber, red to show the priorities or the sequences. So the first thing a prime broker is going to do is if a client wants to borrow shares and it's not on the good to trade file or has exceeded the availability, the first thing a prime broker would do is see if they have any excess inventory from maybe one of their own proprietary trading positions or from a client position where the prime broker has either agreed that they can access those shares or the prime broker is financing the position sufficiently so that the prime broker is legally allowed to use that client's long position for its own purposes, either as collateral or in this case to lend out. Because the prime broker is sourcing this internally, economically, it's the best source. That's why I've got it green. That's the first place they will go to try and find shares. Now, if that doesn't arise, then of course they'll go to their lending community, and three types of lending arrangements. They might have custodial lenders or banks and dealers that are custody holders of the assets for their clients and they lend them out, or non-custody where again they're just lending the securities but they aren't necessarily custodian. And then the green box is the exclusive arrangements. Now an exclusive is where an investor decides that rather than make those trade or those securities available to the entire community of borrowers, they've struck a separate deal with one or more prime brokers that have allocated parts or the whole portfolio on an exclusive arrangement. So only one counterparty can access those securities. And there's pros and cons for doing that. And I'll probably do that in another video. because otherwise we'll get distracted. But look, the bottom line is the borrower is already paying for that. Whether they use the securities or don't use the securities, they're paying for it. So in that sense, from a fee perspective, it's free. But of course, there is still collateralization costs, so it's not entirely free. But that's going to be their priority because they're paying for it, whether they use it or not. So if there's an opportunity to use it, of course, they're going to use it. And then there's no difference between custodians or non-custodians at a macro level. There might be differences at the individual relationship level, but that's not what we're showing. Now, of course, at the end of the day, the prime broker is trying to service their clients. And as much as they don't want to do this, little red box here, that's other banks and securities firms. And in some cases, those firms are competitors. And so that's going to be bottom of their list. But they're there to service their customers. So they may, in fact, borrow securities from a competitor. Now, they probably are going to go back to their client and say, I've tried to get the securities you're looking for. The only place I can find them is somewhere where I don't think the securities are necessarily stable, right? There's not necessarily going to be continuity of those. But if you want to take a flyer, if you want to take a punt, if you are in urgent need of these securities or desperate, I can borrow those for you. Please give me some guidance, because they have to recognize that there's a good probability that those securities won't necessarily be available for the full life of their trade. Okay, so they may do that. Okay, so that's how you prioritize things that either you don't have to pay for, like the internal longs. There's also no collateral costs there. There might be some internal money. So the prime broker might have to pay a fee to the internal desk that owns it, but that's funny money out of one pocket into another pocket within the same firm. But there's certainly no collateral cost there. If there's nothing internal, then they go to exclusives because they're already paying for it. They just have to pay the additional collateral cost. Then they go to their lending relationships. And if all else fails, they go to sort of their peers and competitors. Okay. Hope that sequencing makes sense to you guys. Mohammed, thanks very much for joining. Appreciate you being here. Thanks for saying hello. Okay. Now, again, this slide comes from the June 5th session on the trading side of things. But just as a reminder, there's a number of different ways that trades can happen. The first way is direct messaging. So I might just send you a message. I'm looking to borrow this stock. I could do that over my Bloomberg terminal. I could do an email. Believe it or not, people actually use the telephone, a new invention or not. Okay, so any different way, just a direct method there. The majority of trades get done electronically. So these figures, for example, are taken from the Equilend website. And this is from their NGT platform. But you can see here in this example for that month, which might have been June, but I don't remember, 2 million trades were done electronically, and it breaks it down. That's equities, fixed income, and really global assets as well. And with pretty huge values as well. So 2.2 trillion. So you can see probably the vast majority of trades by value get executed electronically, because the harder to borrow ones tend to be not in the biggest capitalized stocks, smaller transactions, smaller cap companies. And so they are by value probably a lower figure. And then, of course, there is also direct bilateral trading. And that bilateral trading can also be automated. There are mechanisms that firms have individually, or again, for instance, Equilend has another platform where you're trading and directing trades at exactly the counterparties you want, customized for what they need. So 3 different ways that they actually get executed. But how do you get to the stage of executing? Because this is still just communicating, I'd like to borrow. I'm just going to walk you through this process. First, I'm going to get another drink. Okay, so here we go through the arranging a manual trade. That little sound, if you heard, that was my telephone giving me a weather alert, because yet again in summer we have a deluge of rain that's going to be coming, and that was a weather warning. So it's in the low 20s and about to rain yet again. Don't get me distracted. Right. Now, let's go through this locate process. So the end short seller, the end borrower, or the would-be short seller has identified a security they want to borrow. Prime broker is given the security name. It now has to go out. it now finds a lender that has a supply. So they confirm that the lender has that availability and that lender is willing to lend it to the borrower. Because as I said earlier, not every beneficial owner, not every end investor has approved every firm as a borrower. Not every prime broker is approved by every investor. Not every prime broker approves every investor to borrow from. Because remember, a borrower has real exposure to the beneficial owner because they're giving more collateral than the securities they're borrowing. So it's a two-way street. Each has to approve each other. So just finding the securities isn't enough. You need to make certain that the investor that's lending their securities can lend it to the borrower. Borrower goes, great, you've now got the share. You've confirmed that I can borrow them. Now I need to go back to my client to see if they're just looking for this stock or they're ready to execute a trade. And the prime broker will go back to the client and say, I found some shares. Are you interested in borrowing them? These are the terms and conditions. If there's anything unusual in the fees that are involved, the then borrower says, yep, definitely interested in borrowing those. Then the goes back to the prime brokers, definitely want to have those. The prime broker then goes back to the lender and say, yeah, we're ready to borrow. Let's go. And they negotiate the final terms and conditions of that trade, execute the trade, and then you initiate the trade flow. So that's the process. So there's quite a lot of back and forth because just looking for stock doesn't commit a borrower to actually borrowing. And a lender or its agent saying, yes, I have it available, isn't committing them to lending it. So imagine in between the lender telling the prime broker over here that, yes, I've got shares available, and the prime broker then going back to their borrowing client and saying, we found you some shares, are you interested? And them saying yes. And then the prime broker going back to the lender might say, oh, actually, my client sold it. And those shares are no longer available. So both sides have a lot of flexibility here because even if the borrower says, look, I'm interested in borrowing it, before they borrowed it, they can always change their mind and say, no, what? And why might they do that? It could be many different reasons. Maybe some news has come out that changed their mind. Maybe the price isn't trading where they want to execute the short sale at. There could be all kinds of different reasons. And as I said, the lender might decide, no, they don't want to lend it anymore, or they might sell it. So lots of different reasons. So you execute the trade and you get into the trade flow. But if both sides want it, you execute it and off you go to the races. Boom, you've got a trade. That's it. Hi, Nick. Really appreciate you joining. Thanks very much for that. I sent you an email earlier, so hopefully you got lots of reading material there. Thanks for joining us. So that's a trade. That's how you get a trade done. Just as I've been going through this, as you can see, there's a lot of levels of complexity to this. We go through some of in the primer that's free to sign up. We have people signing up for that every day. That just gives you an overview of the business from beginning to end. Doesn't go into a huge amount of depth. Lasts about 50 minutes, I think, and just gives you a perspective on the business. The other one is the paid for course, the Introduction to Securities Lending course. That goes into a lot more detail. I'm in the midst of updating that now, so people that sign up today will get access to the updated course, and that's online on demand. So it's whenever it's convenient for you. You can find out more about this stuff at our website, pierpoint.info, under course. Okay, so have a look at that. So look, we're at half an hour. So let me just do a summary of the trading workflows. So on a pre-trade basis, so before anyone's committed, a good to trade file gets sent out to the would-be short sellers. Those would-be short sellers know that they can trade to their heart's content. They can short sell those positions up to the size that their prime broker has given them. For anything more than that or anything not listed on there, they have to go to their prime broker, who will then go through the locate process as well to contact their relationships to actually source other supply that are beyond that. The trade execution, look, as I said, this is a complex back and forth process if it's being done manually, not if it's being done electronically. If it's electronically, then that's a trade. But the manual ones, a lot of back and forth confirming, are you interested in shorting it? Do you have it? Will you lend it to me? Will you still lend it to me? Are you really still interested in shorting it? And then it all comes together and people go, yeah, I'm interested. And they might actually borrow it without shorting because they might actually be trying to build up a position. So let's say I want to do 1,000 shares. I may not be able to get 1,000 in one piece. So I might borrow 300 today and 200 tomorrow, 400 the next day, and then 100 the following day. And then when I've accumulated the position I want, then I'll go execute the short sale in the market, even though I before then. Okay, so there's lots of nuances to that. And then once the negotiation has been completed and the trades are confirmed, the trade flow process kicks in. And that's what we're going to be talking about next week, the actual settlement of the trade and the post-trade flows. So this has been the quickest session that I've done so far. Very focused on the trading flows. I hope that was of interest to you. That's what we're doing next. That's it. That's me, over and out. Have a great Saturday. Have a great weekend. Have a great week. And I'll see you next week.